You open a Spanish bank account, buy an apartment, maybe keep your savings parked safely in euros, and everything feels stable until someone casually mentions that Spain taxes not just what you earn, but what you already own. Not income, not profit, but your net worth every single year, simply for existing on January 1st, and suddenly the question becomes very uncomfortable very fast. Is Spain quietly taxing your wealth while you are busy focusing on income tax? My name is Hector, and I work with people who move to Spain and only discover later that the real tax surprises were never about salaries or freelancing, but about assets they already thought were settled and safe. The problem with wealth tax, officially called Impuesto de Patrimonio, is not that everyone pays it, because most people actually do not, but that almost nobody understands when it applies, where it applies, and why two people with the same assets can have completely different tax outcomes depending on where they live. This creates confusion, bad planning, and in some cases unnecessary fear that pushes people into expensive mistakes. Stay until the end, because once you see a real example with an apartment, a car, and savings, you will immediately know whether this tax is something you can ignore safely or something you should be paying attention to right now. Wealth tax in Spain is a yearly tax on your net assets, meaning what you own minus what you owe, calculated as of January 1st each year. If you are a Spanish tax resident, this tax applies to your worldwide assets, including property, bank accounts, investments, and valuable items, regardless of which country they are located in. If you are a non-resident, the tax can still apply, but only to assets located in Spain, which is an important distinction many people miss. The key detail is that wealth tax is not applied uniformly across Spain, because autonomous regions have the power to modify it, reduce it, or effectively eliminate it. This means Spain technically has a national wealth tax, but in practice it behaves very differently depending on where you live. For example, regions like Madrid have applied a 100% bonus in recent years, which effectively reduces the wealth tax bill to zero for residents there, even if their net worth would otherwise be taxable. Other regions, such as Catalonia or Valencia, apply the tax more aggressively, with lower exemptions and higher effective rates, which means living across a regional border can completely change your tax exposure. This regional difference is one of the biggest traps for expats, because people choose cities based on lifestyle, weather, or cost of living, without realizing they also chose a tax regime that may quietly apply to their assets every year. Now let us talk about exemptions, because this is where most regular expats realize they are not actually affected. Spain applies a general exemption threshold, meaning your net assets must exceed a certain amount before any wealth tax is due. On top of that, there is an additional exemption for your primary residence, up to a significant limit, which removes a large chunk of value from the calculation for people who own the home they live in. The exact exemption amounts vary by region, but at a national level, there is typically a base exemption of several €100,000 per person, plus an exemption for the main home that can reach hundreds of thousands more. This means a couple filing separately can often shield a substantial amount of combined wealth before the tax even begins to apply. There are also exemptions for certain business assets, pension plans, and other specific categories, which further reduce the taxable base for people with structured finances. This is why wealth tax is often called a tax on paper millionaires rather than ordinary earners, although the definition of millionaire can shift depending on region and asset composition. To make this concrete, imagine a fairly typical expat situation. You own an apartment in Spain worth €500,000, which is your main residence. You own a car worth €30,000. You have €150,000 in savings and investments. You have no significant debts, and you are a Spanish tax resident living in a region that applies wealth tax without full bonuses. First, the main residence exemption applies, which may exclude up to €300,000 of the apartment's value, leaving only €200,000 counted toward your net worth. The car is included at its market value, and the savings are fully included as well. This means your taxable assets might look like $200,000 from the apartment, $30,000 from the car, and $150,000 from savings, totaling €380,000. If the regional exemption threshold is, for example, €500,000, you are below it, which means you file nothing and pay nothing, despite owning property, a car, and substantial savings. This is the moment most regular expats realize that wealth tax is not automatically a problem just because you live comfortably. However, if you add another property, larger investments, or significant assets abroad, the picture changes quickly. Once you exceed the exemption threshold, the tax applies progressively, with rates that increase as net worth increases, although these rates are generally much lower than income tax rates. Still, paying a yearly tax on assets you already paid for feels very different psychologically, which is why this tax creates so much anxiety. Another important detail is that wealth tax is closely linked to income tax, because Spain applies a combined limit to prevent the total of income tax and wealth tax from exceeding a certain percentage of your income. This means that in some cases, the wealth tax bill is reduced if your income is relatively low compared to your assets, although the rules are technical and require proper calculation. The biggest mistake people make is assuming that because they are not ultra-wealthy, this tax does not apply, and therefore ignoring it completely. The second biggest mistake is panicking and restructuring assets unnecessarily, sometimes triggering other taxes, when they were already safely under the thresholds. If you are living in Spain or planning to, the smart move is not fear, but clarity. You need to know whether your region applies wealth tax, what exemptions exist, how your assets are valued, and whether your net position actually crosses the line. Once you see the numbers clearly, the uncertainty disappears, and you can make decisions calmly instead of reacting emotionally. Most regular expats do not pay wealth tax in Spain, but the ones who do usually did not see it coming. And the difference between those two outcomes is not wealth, but understanding. Once you know exactly how Impuesto de Patrimonio works in your specific situation, it stops being a mysterious threat and becomes just another variable you can plan around, which is exactly where you want to be before January 1st arrives again.